Germany's recession is getting from bad to worse. First, we had their economy minister warning of 5 hard years. Now, the latest reports show that the German economy is going to stagnate even further, and it's so bad that in certain measures, Russia has overtaken them as the fifth largest economy in the world and the largest in Europe. And as you'll quickly see, the situation is getting dire because their inflation crisis is far from over. In our lead story today, Germany's economy seen stalling for remainder of the year. GDP is expected to stagnate in Q3 and only grow by 0.1% in Q4, which I'm quite doubtful about. Now, all these forecasts are normally rosier until reality hits, but even the predictions aren't good. It's doom and gloom for Germany all the way till 2025. They will have at best a 0.4% GDP growth for the whole of 2024. And it's not much of a surprise when you have high energy prices, demand from China, your biggest trading partner, dropping, plus record inflation and interest rates. It's a confluence of storms hitting the economy. And if you think Germany will one day link up with Russia for cheap gas, I believe that option is now off the table. Firstly, Putin might not agree because he has effectively shifted supply away from Europe to Asia. There isn't much need to secure European customers anymore. Secondly, Germany is digging in and they'll resist Russia to the end. And here's what their foreign minister said. We know that for the foreseeable future, President Putin's Russia will remain a threat to peace and security on our continent, and that we have to organize our security against Putin's Russia. So Germany is decoupling from Russian energy, but it's not going to be easy, and they will have to pay through the nose. In 2020, 66% of German gas came from Russia, and that is cheap gas that allowed the German industry to be competitive and ultra productive. Now you take that away, you are left with a gigantic hole in the gas supply you have to fill. Now, the issue isn't about really finding supply. You can get it from the United States, you can get it from the Middle East. The problem is finding a source that is cheap enough to keep the electric bill down. Remember that Russian gas came from pipelines. German imports are now coming from LNG transported in tankers, and that piles on additional costs that jacks up energy prices. Especially as we move towards a recession, manufacturing is now a margin war. If you can't provide cheaper goods, consumers will go elsewhere. And here's what the German government themselves said about the energy crisis, and it's a real eye opener. Germany expects gas prices to stay high for several years. Only by 2027 could prices drop back to pre war levels. I don't know about you, but 4 years is a very long time. Can German manufacturing endure for 4 or 5 more years? And to fight higher prices, they have spent almost 23 billion euros in subsidies so far. We can expect even more subsidies coming to cushion energy consumers, especially for German industry. And you might be wondering who is really benefiting from this gas crisis. And the obvious answer is China, right? But another huge winner is the United States themselves. Just take a look at this chart. It shows us America's LNG export capacity, and that's how much gas the US can export out to the world. Ever since the conflict started in 2022, we are seeing exponential growth in export capacity. It is expected to grow from 100 billion cubic meters a year to nearly 160 billion, and a huge chunk of this is flowing towards Germany. And if you are the Americans, it makes total sense to export gas to the Germans. The margins are simply insane. There's almost no way not to make a profit. At its peak in August last year, local US gas prices were around $430, but it was trading for nearly $1,300 if you export it out. Look at the differential, guys. There's virtually no way to screw this deal up. Even when gas prices came crashing down, the margins are still lucrative. Export prices are still double or even triple the local price, so you can make a ton of money by just ramping up the volume. And this is a big reason why the US economy is somewhat resilient, right? The energy sector is booming because of European revenues. Germany, in a sense, is subsidizing the US economy. And the windfall keeps continuing for US energy companies because Germany wants to decouple from Russian energy. They have signed a long term deal to import LNG from the United States. We are talking about a 20-year deal to import 2.25 million tons of LNG annually. While this might help Germany's energy security, the amount of money paid is incredible. Now, the big question is about margins, and if German manufacturers can stay competitive at the current cost of energy, because it's either going to be more subsidies coming or further deindustrialization, and the outlook is getting gloomier and gloomier. it is very hard to say if German industries can survive over the next few years. Germany's IFO index is dropping further in July, and this is a measure of the business climate in the country across all industries, including manufacturing and retail. Any number below 100 isn't good news. The current business conditions peg it at 91.3, but the 6 months outlook has collapsed down to 83.5. And this number shows a contraction, and that will spook out people looking to invest in Germany. Once again, it's about the high cost of energy. The higher it is, the more expensive your final output is, and that makes you less competitive. When other places like India, like China, can manufacture for far less. But there's another legacy problem that is surfacing in Germany, and that is the lack of skilled workers. Now, this is an issue because if your domestic workers aren't qualified, you need to bring in foreign talent, foreign workers to fill in the gap. And once again, that jacks up the cost of production and lowers competitiveness, especially in a recession. According to the IFO, Germany is facing a shortage of skilled labor in over 40% of companies. Manufacturing comes in at 35%, but surprisingly, it is the service sector which is hurting the most, with shortages hitting 50%. And if we zoom out, we can see it is the worst hit of the entire Eurozone. Even countries like Spain and Italy actually have more skilled labor than the Germans. This is essentially a manufacturing hell where everywhere you turn is in a crisis. And unfortunately, it will take time to resolve this, but until then, companies will suffer declining revenues and many will consider relocating away. And a great example is BASF. Now, the company is the bedrock of Germany's manufacturing. They produce essential chemicals, plastics, and fertilizers, and these are essential products that the world really needs, not some luxury cars. But if you look at their quarterly financials, you can see it's a bloody mess. Almost every number is in the red. For the June quarter, their revenue is down by 24% year on year. Net income has crashed by 76%, and their net profit margin has taken a 68% hit. It's red across the board. And focus on the net profit margin, it is down by more than 2/3, which is a crazy amount. And here's what they said: we expect that global demand for consumer goods will grow slower than previously assumed. Margins are therefore expected to remain under pressure. And if this continues, we'll see the company slash more jobs, cut down on reinvestment, and even move production to places like China, which they are already doing. But let's talk about German inflation for a bit. Inflation in the country has always been a problem thanks to the energy crisis. Compared to both the Eurozone average and the United States, Germany's inflation is higher than both, coming in at 6.2%. It's almost double the rate in America, so people are still bleeding a ton of purchasing power. Now, that's just the headline inflation. If we remove food and energy, you'll see that core inflation hasn't really moved much in Germany. It's not coming down fast enough. Since January, core inflation has been hovering well above 5.3%. July's reading of 5.5% shows that inflation is becoming entrenched across the board. And this is bad news because the ECB would see this as a signal that inflation is still a problem. The ECB rate is at 3.75%, while core inflation in Germany is at 5.5%. So there's this big gap between them. And the big question is if German economy can really endure higher interest rates now. The more expensive the cost of capital, companies will have less of an incentive to borrow. And it kind of makes sense, right? Your margins are getting squeezed, the global economy is slowing down dramatically. Looking at Germany's bank lending rate, the cost of borrowing is getting extreme. Just 12 months ago, it was at 2.2%. Now it has flown up to 5.6%. That's more than twice the cost of capital. If this keeps increasing, we could reach a tipping point where banks are afraid to lend because of all the loans going bad and companies themselves not borrowing due to fear as well. And this is the problem with a credit-based economy where everything needs to keep expanding. The moment the music stops, growth will start to contract and then reality hits. Bank lending today is tied to the growth of the economy, right? The more banks push money out to the economy, the more it stimulates the economy. And this is where the story gets darker. We have bank lending growth expected to slow all the way till 2024, with Germany taking the worst hit, dropping from 6% to nearly zero growth. And that's why estimates are predicting Germany to stall for the rest of 2023. Interest rates have to come down, but for now it's impossible thanks to higher inflation. Now, Germany isn't going to go down without a fight. They have managed to convince TMSC, the Taiwanese chip manufacturer, to build a facility in Dresden. TSMC is going to flesh out their microchip supply chain in Germany, but there's a big problem. It comes at a huge cost, and this is where we need to dig into the numbers. So the plant is going to cost around $11 billion, but the company is only committing 3.8 billion to the factory. So who is going to make up for the shortfall? It will be the German government itself. They'll be contributing up to 5 billion euros to build the plant, and it's no wonder TSMC took the bait. You're almost getting half the plant for free. This move is an obvious part of friendshoring chips away from the South China Sea, but it's a big gamble because the fundamental problems of manufacturing aren't solved yet. Energy prices are still a problem, and to solve the labor shortage, you probably have to fly engineers from Taiwan, which would increase production costs. So it's still a coin toss if this factory will give a good return on investment. But there are companies in Germany that are fighting back against decoupling. Not everyone is going to go down with the ship, and they're actually doubling down on China. According to the CEO of Merck, decoupling from China would be at a huge cost, and she clearly understands the situation on the ground. You have to lower your input costs and shorten the distance to your end buyer, and that's why Merck is moving to build supply chains directly in China. And this means the raw materials will be sourced within China itself without any need to import stuff into the country. So even if there are import curbs, import bans, Merck will be fine and it will be business as usual. And here's what they said. We are creating a China for China approach so that also the vast majority of products we are going to produce in China is actually supposed to be for the Chinese market. They are going where the money is because China represents 13% of their revenue, which is a substantial amount. And we are seeing two differing strategies for the energy crisis in Germany. The government approach is to throw money at the equation in the form of subsidies. Now, the private sector solution is a pragmatic one. Go where your customers are and where the import costs are lower. And we won't know which is the winning option, but my money is on a private sector solution, and that seems just more practical. The German crisis is simply an energy crisis, and The Economist recently published a piece that really captures this. The German economy from European leader to laggard. And here's what they wrote. From the mid 2000s to the end of 2010s, Germany's economy grew by 24% compared with 22% in Britain and 18% in France. And the reasons were very simple. China's GDP was growing at 10% a year back then, and they bought a ton of German-made goods. German trade with China rose to a record in 2010, with their exports jumping by an insane 40%. So German demand was strong because they were selling aggressively into the Chinese market. But now they are moving to decouple, which is actually destroying their own demand, which I find quite insane. It's just not possible to find another economy that can fill in the gap from thin air. You can't just snap demand into existence. Then in 2011, Nord Stream came online, and that supplied Germany with Russian gas directly from Siberia, which lowered their energy costs substantially. However, that supply of cheap energy has literally blown up, so cheap gas is out of the picture. So it's basically an equation, right? If Germany wants to bring their economy back from the brink, they have to find another cheap source of energy and then another source of demand to buy their goods. However, it's going to take some time. In fact, it could take many years to materialize, and until then, Germany is going to feel the financial pain. But let me know what you think in the comments below. How can Germany revive their industries, or will they deindustrialize even further? Let me know in the comments below. Stay safe, be sure to smash that like button, subscribe as we navigate through these crazy times.